Win Thin, senior currency strategist at Brown Brothers Harriman. He's joining us now to continue, discussing the dollar and his outlook for currencies. Win, thanks for joining us.
Thanks for having me.
Let's touch on the dollar today, first of all, where we are seeing this continuing decline. It looks like it's tied to some of what's going on with the jobless data. Is that what you would pin it on?
Well, dollar bearish sentiment has really been going full on for really the last several months, and markets are just looking for any sort of excuse. The dollar had been supported for the last couple of days on fears that perhaps the ECB or the Europeans would come out a little bit stronger against dollar weakness, but that was not the case. ECB President Trichet basically gave the same boilerplate discussion about exchange rates that the G7 did. So the markets took that as a green light to continue selling the dollar. So I think the dollar will remain under pressure. The interest rate differentials work against the dollar, and they continue to work against the dollar. So near term, there's not much relief for the dollar.
And why do you think not only what we heard from the ECB, but what we've heard from Treasury Secretary Tim Geithner has been words that say we support a strong dollar, but not necessarily anything to back that up? Is that your perception? Why do you think that's happening?
Well, if you go back all the way to Secretary Rubin, none of these Treasury secretaries really had anything sort of behind their rhetoric except just talk. I mean, Rubin always reaffirmed his stance for a strong dollar, and Treasury secretaries since then have done the same thing. But it's really, you are correct that it is in a sense empty words. But my feeling is that the Europeans have remained fairly silent, but once we get up above 150, we start going to the 150, 155 range, and I think official concern will start to rise. No one wants a stronger currency right now at this stage of their business cycle. I think it's very dangerous for Europe, it's very dangerous for Japan, dangerous to emerging markets, so it's really something we've got to keep an eye on over the next several months.
What do we need to see to happen for the dollar to rebound? Is it going to be other central banks allowing the appreciation of their local currencies?
Well, most central banks right now do not want appreciation. We've seen the emerging markets intervening regularly to prevent excessive dollar weakness against the emerging markets, but they can only slow the move. To me, the fundamental change will be when the interest rate outlook starts to favor the dollar, and that's something that's a 2010 story. At some point, it's going to be clear that the U.S. economy is outperforming Europe and Japan. The Fed right now is tipped to be the first out of those three to hike rates next year. So that's something that's a 2010 story. That's something in the background. But right now, the dollar is really going to remain under pressure until we see some sort of fundamental change.
But we still are seeing a move out of dollars into other markets, aren't we?
Yes, we are. Australia, for instance, hiked rates this week. That was another leg down in the dollar. That's a reminder of how the interest rates are working against the dollar and will continue working against the dollar. So until we see the U.S. economy get some good, strong traction, Fed rate hike becomes more of a possibility. It's hard to talk about a real sharp dollar turnaround until we see that.
Well, and we're not only talking about retail investors here, are we? I mean, are we seeing more diversification of foreign reserves from central banks?
Well, that's an ongoing story, and it pops up every couple of months. But we've been seeing that, hearing that talk. But if you look at the reserve data, the U.S. dollar share of global reserves has remained pretty steady, somewhere between 60–70% over the last 2 decades. And we haven't really gone out of that range. We're still in that range. You look at the tick data out of the Treasury, foreigners continue to buy U.S. Treasuries. But I guess I would stress that you can be diversify out of dollars and still be a net dollar buyer. That is, the growing share of reserves, your total reserves, you can still allocate towards dollars and euros, more towards euros, but you can still be a net dollar buyer.
And what about emerging market currencies? If we see emerging market governments and central banks let their currencies appreciate, what is that going to mean for the dollar?
Well, I don't think the central banks and the policymakers in EM are going to feel comfortable about that really until the global economic recovery has been cemented. Right now, they're doing everything they can to prop up the dollar versus the local currencies. So we've seen Korea, Taiwan, Brazil, all the usual suspects, huge reserve build, trying to prevent the excessive dollar weakness. And I think we'll see that going well into 2010. Once the global recovery takes hold, inflation becomes a concern in 2010, 2011, those currencies can start to sort of appreciate more freely. But right now, they're really trying to hold the line.
All right, Win Thin, senior currency strategist at Brown Brothers Harriman, thanks a lot for joining us.
Thanks very much.